Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm back with another edition of the Weekly Economic Review, this time for the week ending September 2nd, 2022. So a look at this week's markets at the close on Thursday. So red, 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 and red. So of course, it's all about the speech from Mr. Powell last Friday, where the Fed, the chairman, just pushed very hard, was very clear about the Fed's intention to continue tightening and the importance of fighting inflation. So more on the details in a minute, but that pushed interest rates higher, stocks lower, and that gives us the picture here. But maybe very interestingly, if you're investing in bonds, well, the Bloomberg Global Bond Index, which is the index, the broadest index that the market uses. It was created in 1990, so that explains why this story starts here. But it's the first time that we've seen a bear market. So now the global bond market is joining Wall Street, so the S&P 500, the Nasdaq, in a bear market, meaning that it's down more than 20% from their most recent high, and their last high was in early 2021. So there you go, bear market in bonds, the first one in 30 years. So 2022 is quite a year on the markets. So let's move to the speech by Mr. Powell. So here I just copied a few elements from his speech. If I have to summarize what he said in two sentences, the first one is that history showed that if central banks failed to fight inflation when it is emerging like we're seeing right now, then they're running into trouble. Trouble being that inflation expectations become unanchored. You're having difficulty with the credibility. The economic cycle become more volatile. So it's very important for central banks to fight inflation. So that's the first message he sent. And the second one was that, well, to fight inflation, there's going to be some collateral damage. There's going to be some pain for households and businesses. So they need to prepare for that. So those were the two messages that he sent last week. They were heard loud and clear, thus the market reaction this week. And when we look at the data this week, well, we had the ISM Manufacturing Index, which is a very good proxy for US GDP growth. And as you can see, that's the blue line on the chart here. It's still above 50, meaning that there's still some growth. It went sideways on the month, so it didn't fall anymore. But the red line, you see, that's our leading indicator. That's the global monetary policy cycle indicator. And we just look at all of the central banks on Earth, and we look at the last decisions from all of these central banks. Is it tightening? Is it easing? Is it doing nothing? So we do a net of that. And the red line, as you can see, many central banks are hiking, and this is pointing towards a difficult trajectory ahead for the US economy through the end of 2022 and at least towards the middle of 2023. So there's some tough times ahead. This is what our leading indicators are suggesting. So Mr. Powell says that they will be looking at the totality of the data. So it's not just 1 month of inflation or 1 month of the jobs report. So if you look at the jobs report this month, well, we see that the job openings rebounded once again. So that's the blue line on the chart on the left. And the gap between the number of jobs that are opened and the number of unemployed in the US is very high, and it widened a little bit on the month. That's about 5.5 million more jobs that are open in the US than there are unemployed to fill those jobs. So the labor market remains very tight. And on the right, you see that you had 315,000 jobs added in August. That's a slowdown from last month, but still very strong pace. So we're far from Goldilocks here. The labor market remains very up. So if you look at Canada now, so Q2 GDP was still pretty strong at 3.3%, a bit below what was expected. The expectations were for above 4%, but still pretty good. Consumer demand continues to be very strong, but housing is starting to weigh on GDP already. So housing, so the new constructions, renovations, but also all of the transaction fees that are around housing. It was such a strong growth for a while that the fact that it's slowing down now is starting to hurt GDP growth. So Q2 was still pretty good. but a bit less than it could have been because of housing, and there's probably more of that in the future. So now maybe a summary of our position and views before we go into what to expect next week. So there's been a lot of talk this week, this year, and this summer about the market sentiments, the ins and outs. So we still think it's good to be overweight money market, so to have cash on hand to be able to pull the trigger on opportunities, and opportunities there will be down the road. So we still have cash on hand. We still think it's a good idea to have a bit more bonds with some more duration as a diversifier in the portfolio. So we're slightly overweight bonds. In equities, we're underweight every region right now, meaning that we are in total have a strong underweight, so about 3 to 5, 6%, depending on the mandates on equities, and neutral for styles, gold, and currency. When this was the left part of the table. On the right, when you look 12 months ahead, we are pretty constructive on equities because history tells you that when you're already down 20-25% in the stock market, well, if you invest then and you just look 1 year, 3 year, 5 years ahead, usually those were pretty good buying opportunities. So if you're a long-term investor, and we always recommend that you focus on the long term, then investing now makes ample sense. That doesn't mean that your bet will be positive in 1, 2, 3 months, but in a year, probably you'll be happy that you invested today. So this is where we're at right now. So next week we'll have the Bank of Canada rate decision. Will it be 75 basis points, 50? So I think those are in the mix. 100, it would be surprising, but we'll have a decision next Wednesday. We still think that between 50 and 75 basis points, this is the way to go. Jobs creation last month, we had a loss of 30,000 jobs. Let's see if we return to gains. Unemployment rate was at 4.9 in July. And in the US, finally, we'll have the ISM Services Index. So a pretty slow week in the US. So that wraps it up for the week. ia.ca/economy. If you haven't done so, please take a look at our podcast, the In Your Interest podcast. There's a lot of material that's already recorded, will be published soon. So there's already multiple episodes available, and we plan on keeping on going for years to come. So feel free to join. Economy and Finance 101, there's some new material coming every single month, and you can follow me on the social media, LinkedIn, and on Twitter. So that wraps it up for this week. I'll see you again next week.